This one chart tells us so much about what is going on in the Chinese economy. China is going through a once-in-a-century development story, similar to what the US did from like 1900 to 2000. But unlike then, we now have a modern understanding of economics to kind of understand what's going on. So here's the article that kind of prompted all this, why China's overcapacity problem is about to get even worse in 7 charts. Now, the title's a little doomsday, and you'll see that the article itself is a little bit more even-handed, but I think it's important that we kind of understand where we are right now with China. China really emerges on the world economy in the early 2000s during what we now refer to as China shock. During this time, they were a major manufacturer of low-cost goods, commonly referred to as the world's factory floor at that time. But as with most manufacturing powerhouses, eventually other places come around with even cheaper labor and the competition becomes pretty stiff. So to continue their growth, China really starts to focus on domestic projects, especially their real estate. And their real estate really starts taking off as it has a major impact on their economy. But like so many real estate booms, it eventually goes bust. The Chinese government does kind of a poor job of wrangling in, along with a bunch of corporate and banking greed and poor regulations, just like our 2008 real estate crisis. And China's really right now in the quagmire of that, and they're rolling out programs to try and save that, but it's going to cost a bunch of debt, and they're hoping to fund that debt with kind of a major push back towards manufacturing. But unlike the early 2000s with cheap goods, they're really trying to get into highly sophisticated goods, things like solar panels, electric vehicles, and steel production. So now that we kind of understand where China is in the middle of a real estate quagmire and how they're trying to get out of it or return to production, let's jump into the charts. Here's the first chart. The title says it all. Defining overcapacity is hard, but one measure stands out. So the most important thing to understand here is what this axis is, which is Chinese manufacturing investment change from a year earlier. What that means is anything above this 0 line means that they're doing more investments than they were last year. So for over the last 4 years, investments into this black line, all manufacturing, has been going up, right? About 10%. It's in the 10% range. So each year they're investing 10% more than they did last year into manufacturing and production. That would be fine if there was good news coming out of their manufacturing and production, kind of enterprises. But as we're going to see, this is probably the other side to this graph and this tough story, which is gross margin. We're talking about profits here. Now, manufacturing is already really tight on profit margin, right? It's not a very high profit margin business because it really comes down to labor. And China's profit margins have fallen from 6% in the late 2010s to under 4% recently. And right here, you can see that in this chart. So this is actually standard deviations, which I'm not going to get into, but just think of it as kind of a percentage away from the long-term average. We see that gross profit margins were growing until, kind of around COVID, and then they have been steadily shrinking, that 6% down 4%. And they put investment growth, this green line here, on the chart just so that they're still sinking money into it, even though profit margins are going down, which is going to make sense in a minute here. For example, export prices. So this is various Chinese products. This green up here is electric vehicles, batteries, all autos, steel, and then this yellow line is solar. Now this doesn't spell a doomsday scenario to me. Prices are up for things like lithium batteries and electric vehicles, and they've been relatively constant over the last couple of years. But you do see this dramatic drop in solar cells, which will make sense here in a minute. So I don't think we're in disaster mode yet, which is going to be important as we kind of look through the rest of these charts. All right, here is really this story about the shift from real estate to manufacturing. So this is Chinese banks' loan book. So this is total loans on the books. So if it's flat like here, you've seen it over the last couple of years in the real estate market, that means that they're not taking on any more debt, right? So there's not a whole lot of new real estate loans or mortgages going out because they've already built so much. There's not a lot of building going on in terms of real estate in China, but all other loans have gone up significantly. Now remember, this is bank loans, so even though this is a massive number, it's 193 trillion, US sovereign debt's like 34 trillion. We're not comparing apples to oranges there. But this does tell an important story. This China economy that was kind of all consuming 5 to 10 years ago, we were worried about overtaking the US economy because they were buying up all our debt. They didn't have any debt of their own. They just seemed to be doing everything right. That story's really come apart. China is starting to have their own sovereign debt, and they have all this kind of hidden debt. I will share a video at the end about this whole real estate story. It's fascinating, its comparisons to 2008. But China's economy is really starting to look like, a more modern nation with sovereign debt that will probably last forever. So, all right, this is a tough graph to understand exactly why it's bad because, both lines are going up. So this is solar cell production compared to domestic installations. So showing that they've been producing way more solar panels. Remember those things that the prices have dropped almost in half. And they've got 156 gigawatts of production right now, but they're only installing locally 88 gigawatts in China, which means they're trying to sell the other 90 gigawatts around the world. And who else right now is trying to produce solar panels? Not just the US, everybody is, right? Everyone's trying to win this kind of green revolution race. And unlike the first China shock, which kind of globalized all sorts of manufacturing and supply lines, and companies kind of blindly rushed into, and the US wasn't really quite ready for regulations on what it would mean to globalize your supply lines and manufacturing all over the world, including to partners that you might not necessarily want to be tied to, like China. Now we do, and the rest of the world is very resistant to buying up all of these cheap but high quality goods for lots of good reasons. So China's seeing a lot more political backlash and a lot more concern over countries that don't necessarily kind of want to get in bed with Chinese manufacturing. So for them to sell this major difference is going to become increasingly difficult. Here is their Chinese steel production, right? So it's showing that this really isn't getting too bad. Output looks high, but not overly high. This is 100%, right? So they're not producing that much more than what they're consuming in their own country. This kind of doomsday scenario, like back here, where China is exporting all this cheap steel, isn't necessarily a credible source, although it is, again, creeping up higher recently, but prices have also been coming down because of this, and that profit margin dropping from 6 to 4%. This is just showing profit margins on specific scenarios, and this is a good news story, right? Autos have been relatively flat, electrical equipment fairly flat, iron and steel kind of dropping dramatically, right? Profit margins in the 9%, down as low as in the 2% range. That's a really tough story. So let's kind of return to that one last chart, and we'll kind of do a little recap here. This one that kind of tells it all. It's one thing to have gotten to overcapacity and then backed off, right? Even in a free, completely capitalist free market, we would see the pendulum swing kind of too far and come back. But if China continues to double down on this when they're already into a point where they're hurting themselves in terms of profit margins and political unwillingness to accept their goods, then this could turn out to be the exact same story as their real estate market that they've been going through for the last 6 years. And if this becomes a giant debt trap that the real estate market did, this could really do long-term damage to China. The good news story here is that they're really not beyond the point of no return. China can pump the brakes here, take a little bit slower growth, and become a major player in the kind of global supply of all of these, kind of sophisticated goods. But if they take the approach that they probably did 20 years ago and just try and outcompete everyone on price, they're going to face a very different world compared to, the kind of happily receiving world of 20 years ago and the much more concerned world in the post-COVID global supply chain disruption world. So we are not at the point where they're at the same spot where they are with their real estate market, but China needs to take action here and make sure they don't get to the same spot with their manufacturing. Now, if you are interested in what I've been referring to out through this whole video about what's going on with their real estate market, then here's that video that I promised that kind of goes through all the parallels of what's going on there and the incredible commonality it has with the 2008 real estate bubble that we went through in the global financial crisis. I hope you enjoy that video. Otherwise, stick around the channel for similar content, and I will talk to you soon.